Hey everyone, welcome back to the channel. Today we're diving into something that affects almost every part of your financial life, your credit score. Whether you're applying for a mortgage, getting a credit card, or even renting an apartment, your credit score plays a huge role. So, let's break it down and learn what your credit score really is, how it works, and most importantly, how to improve it. A credit score is a three-digit number that tells lenders how creditworthy you are. It ranges from 300 to 850, with higher scores making it easier to get approved for loans and secure better interest rates. In other words, your credit score is like your financial report card. The most common credit score system is called a FICO score, developed by the Fair Isaac Corporation. While there are other credit scoring models out there, FICO is the one most lenders use to assess your creditworthiness. So when you apply for things like a mortgage, credit card, or even a personal loan, lenders look at your credit score to figure out whether you're likely to pay back the money they lend you. Now, let's talk about the different credit score categories. Generally, the higher your credit score, the better your chances of getting approved for loans with lower interest rates. Here's a breakdown of how credit scores are typically categorized. Excellent. 800 to 850. Very good. 740 to 799. Good. 670 to 739. Fair. 580 to 669. Poor. 300 to 579. So, if your credit score falls into the good or excellent range, you'll have an easier time getting approved for credit. But if it's in the fair or poor range, don't worry, there are ways to improve it. Your FICO credit score is calculated based on 5 key factors, each contributing to your overall score. Here's what they are. Payment history, 35%. Amounts owed, 30%. Length of credit history, 15%. Credit mix, 10%. New credit, 10%. First up, payment history. This is the most important factor. Lenders want to see that you pay your bills on time. Even one late payment can ding your score. Next, amounts owed, also known as your credit utilization rate. This is the percentage of your available credit that you're using. It's recommended to keep this below 30%. So if you have a $10,000 limit, try not to use more than $3,000 at a time. Then we have length of credit history. The longer your credit history, the better, since it gives lenders more data to understand your financial behavior. Credit mix refers to the different types of credit you have, like credit cards, car loans, or a mortgage. Lenders like to see a variety of credit types. And finally, new credit. Opening too many new accounts in a short period can make you look desperate for credit, which could hurt your score. Let's bust some common credit myths real quick. Myth number 1. If I close a credit card, it'll help my score. Wrong. Closing a credit card can actually lower your score, especially if it's one of your older accounts. Myth number 2. Checking your credit score will hurt it. Not true. Checking your own score is called a soft inquiry, and it doesn't affect your credit at all. So go ahead and check it regularly. Okay, now that you know what a credit score is and how it works, let's talk about how to improve it. Here are a few simple but effective tips. Start by paying your bills on time, every time. Even one late payment can lower your score significantly. Next, consider increasing your credit limit, but don't use the extra credit. This lowers your utilization ratio, which is great for your score. Improving your credit score doesn't have to be overwhelming. By understanding how it's calculated and making small, strategic changes, you can boost your score and put yourself in a better financial position. Thanks for watching. If you found this video helpful, be sure to hit that like button and subscribe for more tips on managing your finances. And don't forget to drop a comment below if you have any questions. See you in the next video. Until next time, stay smart with your money.